Hi everyone, good morning, and thank you for joining us for our latest York Economic Snapshot. It's so lovely to have you here with us today. This is the third webinar in our quarterly series where we share the latest trends and insights shaping York City Centre's economy. And this session will focus on the economic performance of York City Centre during quarter two, which is April to June of this year. Just to let you know, this session is being recorded and we'll be happy to share the video and presentation slides with you afterwards. If you have any questions, please just pop them in the chat and we'll come to them a little bit later. Next slide, please, Chris. So just a quick introduction. I'm Rachel, I'm the project manager at York Bid, and I'm joined by my colleague Chris, who is our business manager who'll be leading the session today. We're going to start by going through a little bit about what York Economic Data Hub is all about. Chris is going to take us through the UK economic outlook, and then we'll go straight into the York City Centre insights during quarter two, before doing a deep dive into the customer demographics, which I hope you all find really insightful and informative. After that, we'll go into an open discussion and Q&A, so please keep putting your questions in the chat and we'll come to them a little bit later on. The session is expected to last around an hour, so we hope you all enjoy it, and please, as I say, please do keep sharing your questions. Next slide, please. So just a little bit of background as to what this hub is all about. So this platform is about bringing together a range of different and trusted data sources to give us a clear insight into how York City Centre is performing. And it's being delivered in three key ways. So through this quarterly webinar series, and through a monthly insights report, and our new interactive platform, all of which can be accessed on the BID website. So make sure you do go there after this. If you're new here, if you've not been using the hub yet, you can find our last webinar where we talk you through exactly how to use it and how to use all of those interactive features. So I'd encourage everyone to go to the BID website, which we update regularly with the latest trends and insights. Next slide, please. So what is this all about? Why are we doing this hub? So I think we can all agree that now more than ever, we need reliable data to be able to respond to the issues that are affecting our high street businesses and to develop long-term solutions so that our high streets don't only survive, but they can thrive. So here we hope that we are equipping local businesses with actionable data to support operational and strategic decision making. As I say, providing that robust evidence base to Sorry, the slide's gone there. Thank you. Robust evidence base to evaluate the impact of projects and strengthen our case for future investment in the city, supporting policymakers to make informed decisions on critical city centre issues that are affecting our businesses, and to promote a consistent and data-led narrative around York's economic health. Thank you very much. Next slide, please. And last thing from me, so the success of the hub relies on a strong network of key partners, and we'd like to take this opportunity to thank Mayor David Skaith and the York and North Yorkshire Combined Authority, who are funding the hub through the Vibrant and Sustainable High Streets Fund. And we're also working closely with York St John University and the City of York Council, so huge thank you to them for their support as well. So now I will hand over to Chris, who's going to take us through the UK economic outlook. Thanks, Chris.
Sorry, unmute. Tech always confuses me a little bit. Thank you very much, Rachel, for that excellent introduction to what we're trying to achieve through the Data Hub. To kick things off, I thought it would help to add a little bit of context briefly by mentioning some of the recent goings on in the wider UK economy. And you can see the slide that's on screen at the moment is literally a dump of some of the headlines that I grabbed from the BBC News feed just yesterday. Some of these headlines are actually now outdated. The inflation figure for July has changed as of this morning, so it was a good thing that I was watching the news before the webinar started. Otherwise, I was going to give you out-of-date figures. But that's just an example of how dynamic some of this stuff is and how things are changing on a day-to-day basis. It makes it very hard for us to keep up and know what's happening. But this hopefully helps to paint a picture of the current climate that we find ourselves in. Specifically, in terms of top stories for this week, the Office for National Statistics has published that UK inflationary figure for July, which was previously it was estimated at 3.8%, which is a considerable jump up from the previous month, which was, I think it was 2.7. That's actually been revised back down to 2.9, which is a bit of a relief, really, because these, inflationary figures can really drive up the cost of, consumer goods, reduce consumer spending habits as a result. And the CPI, which you can see on the graph there, is literally a measure of the rate at which those goods and services are increasing over time. So 2.9% higher than they were in July 2025. And that, just to give you clarity on that, that's basically if the figure was to reduce to zero, that would just mean that the amount of cost was staying the same, not that the cost had reduced to zero. If that's the way it works, it's a year-on-year difference. But the bulk of the increase for this most recent month has been driven by a sharp rise in fuel prices, which are probably not surprised to hear, which in turn has affected many other industries, particularly those reliant on haulage and long distance delivery of goods. The rise in inflation is it threatens to slow the recovery of that household spending power. That we've seen some of reduction in consumer confidence over the start of this year because of lots of stuff that is happening that's out of control, which is driving up. There's a fear that costs for household are increasing and will continue to increase moving forward. So, in response, the Bank of England voted recently to keep its interest rates at 3.75%, and that's to control the inflationary rise and try and keep it in check. And that's over concerns that continued shocks to the energy industry. In particular, will continue to drive that inflation up, potentially even higher than it is now, up into the 3s and 4% percentiles. And this is against the backdrop of a UK economy that is and has been growing relatively slowly for the past couple of years. In quarter two, it was just 0.4%. So the growth not filling the gap that the inflation has created. So technically we're all worse off as a result. So that's the bad news, but there are positive stories on the horizon, and most of them are being kind of pushed out into the media by this man here, Andy Burnham. If whether or not you choose to believe him or not, Andy has sort of made a pledge. He's identified high street renewal as a key priority for his policy, and he wants to reform business rates to better support town and city centre businesses across the UK, which, yeah, it sounds like a very positive thing on paper, but not necessarily an easy thing to achieve. The current proposal that Andy has put forward is a 20% reduction for pubs, social clubs, and live music venues, which is very welcome, supposed to come into effect in April 2027. But there's lots of criticism that doesn't go far enough to support particularly the hospitality industry, who are recognised to have been hit the hardest in the most recent government changes to government policy around business rates and how they're calculated. Alongside this, there are campaigns lobbying to and I suppose putting more pressure on the government to change the business rates model into something that's fairer and takes into account things like online sales. The Real Rates Reform Alliance is currently gaining some traction, and you can read more about that on their website. We've given you a link there that you can do a bit more reading at a later date. The government is also reviewing wider measures which are aimed at easing pressures on households and the consumer, which could, help sort of bring us back from some of those pressures that we're seeing in the more global economic view. So that's a very, very quick overview of what's going on nationally. But we're here to look at what's happening here in York and kind of contextualize against that backdrop. So we're looking specifically at the 3 months across the period April to June in the year of 2026, which we're classing as part of the calendar year as Q2. Admittedly, this is a very graph-heavy presentation, so apologies for that. But I think hopefully you'll find that all the graphs are presented in a very similar way that's designed to help you kind of interpret them once you've got your head around that. And I'll do my very best to explain how they work so you can kind of pick this up, but then it'll also help you interpret some of the content that you'll see in the Data Hub if you want to go there and kind of look at some of this information in your own time. All of the information that we're looking at here is available online at the BID website. But if you do see anything that you think doesn't make sense or you don't understand, then there are no stupid questions. Please do pop your questions in the chat or raise your hand during the Q&A at the end, and we'll do our very best to answer all of them. And it may turn out that we've presented something incorrectly. We're not infallible, so please do query the data, and we'll do our best to explain it. And with everything we're showing you today, we'll be happy to share the content after the webinar. We'll email you the slide deck and relevant links to the content, so you can go and browse this at your own leisure, and you don't have to be scrolling notes and those kinds of things. Right, so on to the data at hand. We'll start by examining the spend data for Q2, which is powered through our Beauclair data set. So that's specifically a data set comprising of 1.5 billion UK debit card transactions, which are recorded annually. And that represents around 7.5% of the total amount of debit card spending with any given year in the country. So, a decent sample size, and one that the more we've worked with Beauclair, we're confident that it's actually representing, things that we're observing happening in the retail space in York. So, the more we use it, the more confident we are that it's actually, generating results that we think are accurate. The insights that you're about to see are all in reference to transactions that have been made in person or in store at businesses which are within the York city centre area. So it's very specific to the city centre. And it's important to note a couple of caveats about the data that essentially they don't include credit card transactions within these figures. There's no online purchases or cash payments involved, nor are debit cards which are issued from outside of the UK included in this data as well. So it's just the in-person spending at the store. So there are some limitations on what stories we can derive from the data. But getting straight into it, this is a broad view of how York is comparing in terms of performance to the rest of the UK. Figure 1 shows us a comparison of the year-to-date growth across key spending metrics. So in this case, we've got from left to right. The blue columns are the total number of sales, so actual amount of spending that's occurred within Q2. The number of transactions is the magenta. The number of customers associated with those transactions, the account holders. And then the teal is ATV, which stands for average transaction value. So that's basically the number of sales divided by the number of transactions. And then ARPC, which is the average revenue per customer, which again is just the number of sales divided by the number of account holders or customers in this case. So, straight off the bat, there's lots of acronyms being thrown around here. Hopefully you'll come to terms with these and recognize them quite easily. But there is a glossary of terms document based within our Data Hub website, which you can refer to in the future, and we'll make sure you've got a link to that in the content that gets shared. So please stick with us. So in terms of what we can derive from these findings, so we can see off the bat that overall sales, customers, and transaction numbers are all remaining quite low, in a negative growth compared to 2025, which is not the best place to be, I suppose, but you're very much following the UK benchmark in terms of those three metrics. They're all very similar, with York just being ahead of the curve on sales, just 0.6 percentage points ahead, minus 3.4% growth. And then transactions and customers are kind of a mix of one another. York slightly behind by 0.4 percentage points on customers. I think the interesting thing here is that we've actually outperformed the rest of the country in terms of growth on the average revenue per customer. So we're seeing more, we're seeing customers that do come spending more on average compared to the previous year than the rest of the UK is. So that is the thing that's driving the sales in York, despite this loss of customers around 5%. So yeah, stronger spend per customer, helping to offset the weaker customer volumes. Now, this is very much the same view. It's the comparison of the sales specifically, but across, I suppose, what you call comparator areas or comparator cities across the rest of the UK. And you'll see within the legend there, we've got the magenta column is entitled shopping centres. And this is actually an individual boundary that we've drawn to capture spend within the Monk's Cross, Clifton Moor and York Design Outlet retail parks. So a really interesting comparison to make with the city centre, and I suppose some interesting findings across these 6 columns. Firstly, year to date, York has significantly outperformed Chester and Bath, which we're thrilled about because they're very similar in size and in terms of their offering, with heritage buildings and quite a similar makeup of the high street. So interesting to see that York's doing better than 2 of our comparable cities. But then out of town shopping is actually outperforming York and all of these other areas quite consistently in terms of sales growth, at just 0.7% down on the previous year. So sales similar to what they were last year, despite potential losing customers there as well as in York. So yeah, quite a mixed picture there. We are often a little bit sensitive around sharing this sort of comparison with other cities, because obviously there's a lot going on in terms of the size of the area that you're looking at and the number of businesses within it. So we have to take this with a pinch of salt, but it does give us a good barometer for where we sit within the country. Right, moving on to figure 3. This is probably one of the graphs that I refer to more than any other, and that's the total monthly sales trends for York from dating back to 2024 until the current month. And the percentages that you see above the columns there, the year-on-year growth. So essentially a comparison of performance in the current month compared to the same period in the previous year. And we've pulled out the quarterly averages as well at the bottom, which you can see under the January to March for quarter 1 and April to June for quarter 2. So straight off the bat, we can see that sales performance in York improved in quarter 2, despite being down and experiencing a particularly weak May. So May had the worst sales growth of any month within 2026 to date, comparable to March, which was down 7.6% as well. But June has actually delivered York's first month of positive sales growth in 2026. And now we're outperforming the UK benchmark by I think it's about 7.6 percentage points, the UK benchmark being down at -4.5. So there's a real big gap opened up there, which is positive on the forefront. But I think actually, if we look at the longer term trends, this actually points towards what was a comparison with a really quite relatively strong start to 2025. So that's why performance has appeared to be down on sales in 2026. But then in 2025, that sales strength fell off a cliff in June, and that's why we're now seeing growth within June in the current year. And I think because of this shift in trends from 2025 being strong at the start and maybe a bit less strong towards the back end, we will actually see the year-to-date sales figure sort of even out a bit more as the rest of the year is going on. That's what I might potentially put money on that we'll see, but obviously no guarantee. But yeah, eager to see how that sales growth translates into the rest of the months within the year. And again, this gives just a very similar view of what's happening with the monthly customer trends. As we've seen in the year-to-date figures, York is down 5% on customers, and that's because of every month we've seen a decline, and that's true of the UK benchmark as well. So, the decrease in sales is really being driven by this reduction in customers, because as we know, as we've seen, customers on average are actually spending a little bit more than they were last year, and we're beating the UK benchmark on that average revenue per customer as well. Okay, so if you're still with me, we'll now move on to the individual sector performance within those sales figures. So again, these are showing sales for York and the UK benchmark, but we've broken it down into the top 5 performing sectors within York City Centre within Q2, and they are from left to right. In the blue column, we have food and drink. The magenta column, there's general retail. Orange column is fashion. Teal is grocery, and grey is health and beauty. Now, you may think that it's odd to separate general retail and fashion at this stage, but that unfortunately is just the way that this system is built, so not something that we have any control of. There is a FAQ document for Beauclair, which again is published on the Data Hub, which gives you a breakdown of the different kinds of businesses and subsectors that sit within each of these, which you may want to go and review after the fact. But what we can see from this data here is that sales are significantly down across all of the top 5 performing sectors, which you would sort of expect given the reduction in overall sales, except for the health and beauty sector, which is a really interesting kind of standout figure of 2.7%, which is actually 5.4 percentage points ahead of the UK benchmark. So a really interesting sort of outcome there, and one that we probably need to do a bit more investigating on to understand the reasons why. So I will go back to Beauclair and interrogate them on why we think that sector is doing particularly well, offset against all of the rest of this decline. But broadly, all of the other sectors have declined in line with the UK benchmark. Food and drink slightly behind, fashion slightly ahead, grocery slightly ahead. The other standout is general retail, which unfortunately is experiencing noticeable weak performance in 2026, quite significantly behind the UK benchmark by 3.7 percentage points, at nearly 10% down for the year to date. So that's quite a worrying outcome for us in terms of it being down, but it also being quite far behind the rest of the country. So certainly something that we want to keep an eye on. Now, this gives us a slightly different view of the sector performance. This is, all of the sectors that we have figures for, and their sales performance for the current quarter compared to the previous 2 quarters, and the percentage figures again show the year-on-year growth for that quarter. And I suppose what we can observe here is that key sectors have seen consistent declines, and notably, fashion and retail being some of the biggest declines at around 10 and 11%. So again, feeds into that worrying picture of retail underperforming, and that continuing into Q2. Food and drink experienced a record low for the past couple of years, for this quarter, down at 5.1%, but that sector still very much accounting for the largest share of the total debit card spend, around 36%, and that is a trend that we see consistently across all of the historic data. Food and drink is the standout biggest driver of sales in the city, certainly in-store debit card sales anyway. And another thing to point out about this bar chart is probably just the lower representation of sales for tourism and entertainment, which are the sectors representing hotels and attractions. So because the majority, we can assume, of sales for those businesses are made in advance and online, that's underrepresented in the figures that we can see here. So yeah, very interesting to see that entertainment in-store spending is up 14%, but we're not really getting the full picture of how those sectors are doing. So just another caveat to add on to this data that we can see here. So maybe partners on the call can give us a bit more insight into how their specific areas of work are doing when we chat later on. Now, this is a view which I find really useful and really interesting in terms of the narratives that we tell ourselves about York and the visitors that come here. So York residents were the largest contributors to city centre sales during Q2 over any other region that we have tracked here. So we're able to track a number of regions. There's a limit on the number that we have. So these are the ones that we've chosen. So that's the York local authority area, which is basically anyone within the York Council catchment, and then the boroughs of Yorkshire, or the ridings of Yorkshire, sorry. So east, south, west and north, and then northeast catchment as well. And then the magenta column is basically the rest of the country. So yeah, what we can observe here is that residents within any given quarter that we can observe in the historical data account for anywhere between 35 and 45% of all sales consistently. So, residents are a big driver of spend in the city, and that isn't changing. That hasn't changed. Although the share in this quarter is marginally down on the same quarter in the previous year and further down from the year before that. So indicating that there is a bit of shift occurring here, and potentially we are losing some residents' engagement. And then the other interesting thing is that, around 70% of all spend essentially comes from Yorkshire. So York and its hinterland are really the biggest supporters of spending in the city, and that helps to crystallize, I think, where the value is and where we should be targeting our marketing, or our, I suppose, appreciation for the profitability that our city centre can offer. Then this is another view of, I suppose, the monthly sales trends, but specifically for those residents based in the York local authority area. So this is showing us just the spend made by those residents, both monthly and then the quarterly figures underneath. And what we can observe here is that despite, that continued importance that we've talked about, spending by the residents is down 3.6% in Q2, and has actually been on a downward trend since as far back as January 2024. So we are seeing, and you can see that represented in the slope of the bars from left to right, that we're seeing less and less resident spending happening in the city over time. And it's something that I think as a bid, we're really keen to, I suppose, tailor a lot of the work that we do to try and encourage those residents to come back, and I suppose use some of the more retail-based city centre offerings that are out there, because we know those are the ones that possibly get less interaction from tourists. And yeah, this is concerning in the context of year-to-date sales growth and that out-of-town offering from Clifton Moor and the likes, because they're potentially the winners in this scenario where we're losing spend, because it will ultimately be going somewhere. People aren't just sitting at home doing nothing, even though we do have a more conscious and cautious consumer market at the moment. Right, okay, so that kind of concludes the spend section of the update. I did want to just briefly look at two other data sets before we kind of conclude this section. The first is the BT Active Intelligence platform. So many of you will have heard me talk about this before, but this is a new data product that the council have invested in, and we're really pleased because it's actually it's delivered by a credible organization, the BT and EE phone network. It's actually able to capture any mobile device from that network that enters the York area, and they boast like a catchment, a sample size of 24 million mobile devices, customers captured every year. So this really is kind of the gold standard of sample sizes, and that's probably BT's biggest strength. So this is giving us an alternative view to footfall that we might have originally got from the Springboard footfall cameras that are based in Parliament Street and Micklegate. And this is the results that that BT Active has been generating on footfall. We've presented it again in the same format that we have presented the the spend and the other metrics from the Beauclair data set. And what we can see here is, yeah, very similar to the sales. We're seeing quite large declines in footfall over all of the months of the current year, and year-to-date footfall stands at 8.6% down. It was 9.5% down for quarter two, which is a more exaggerated decline than what we saw in quarter one, which was just 7.6% down. So, yeah, overall footfall declining, which is obviously not good thing to report on, but relatively kind of correlating with what we've heard with spend. Now, this data is only available as far back as October 2024, so there are kind of limitations on how much comparison that we can do, but it's going to be a real asset moving forward. And as I say, likely to be a more reliable. Now, the work that we've done to try and identify that, and what I want to illustrate to you now is so this graph, which is we've put together the monthly comparison of year-on-year growth across different performance metrics from the different data sources that we've just talked about. So in terms of the legend that you can see here, we've got the BT active footfall in blue, and this is the growth year on year. So the kind of monthly numbers compared to the previous year's monthly numbers. Springboard in orange, which is also measuring footfall, albeit a different methodology of data capture. And then we've got the magenta for Beauclair sales and the teal for Beauclair customers. So I think you'll agree that, on the whole, BT and Beauclair are telling a consistent story in terms of the direction of travel. We're seeing uplifts and declines in similar places, although there is some larger differences in I suppose, the footfall and the sales in April and June of this year, which is interesting, suggesting, higher sales despite much less people, which is maybe calls for a little bit of investigation. But on the whole, quite the two data sets are correlating on the most part. Then with the Springboard data, this continues to diverge significantly from the other sources, and it's consistently since 2025 been producing what I might call exaggerated results, and that's declines between 16 and 30%, which is very hard to kind of stomach as being accurate. I think this is, also in the context that we're also aware that these cameras have had a number of technical issues over the past couple of years. It's likely that Springboard's actually used algorithms to fill the gaps where we're missing data. So overall, these are the reasons why we've decided to stop publishing the Springboard data within our reporting, and I suppose using this as an opportunity to encourage you to all do the same. Okay, so moving on, final view of the quarter two sort of performance and insights is to look at shop vacancy. We talk about this fairly regularly. It's basically a measure of the number of vacant units compared to the total number of retail unit stock, so that the vacancy is presented as a percentage, and this has been tracked for a long time in York. The data is available on the York Open Data Platform, which is run by York Council. And it's essentially telling us that York vacancy rates have witnessed a significant downturn since the start of 2025, which is very similar thing to what we reported at the last webinar. These reached an all-time low in April of this year, so the start of the quarter two, at 4.9%, and have since risen slightly up to 6.1%, which has left the quarter two average at slightly higher than the quarter one average of 5.6%. But more or less the same sort of area, and generally you're performing very well in the context of the rest of the country. As part of their 2025 retail review, Knight Frank quoted the average UK high street vacancy rate for quarter three of 2025 at 13.5%. So that was quite a few quarters ago, but we can still be confident that 6.1% is still considerably lower than where we could estimate the high street figures being today. So York really doing well in that area, despite us I suppose visually we're seeing some of the large retail spaces still empty, but on the whole, in terms of the numbers, York showing a very good vacancy rate compared to the rest of the country. Right, okay, so just to summarize what we've talked about, and then we'll have a quick break and see if there's any questions that have come through the chat. So sales performance is showing signs of recovery in June. June delivering the first month of positive growth in 2026 and considerably outperforming the rest of the UK or the UK benchmark. But this, we need to remember, is in the context of quite a strong start to 2025, but then a poor end. So that's why we're likely to be seeing those growth figures shifting. But we can potentially be optimistic about that year-to-date figure growing, considering that it was a poor end to 2025, and we'll see that hopefully sort of leveling out a bit. But success will very much depend on the comparison with what's going on in national trends. Then growth is being primarily driven by higher spend, despite a reduction in customer numbers, and suggesting that businesses are extracting greater value out of each transaction despite that decrease in customers. So in other words, businesses are kind of, there's more pressure on them to concentrate on producing those higher sales with less customers, which is potentially tricky, but something that we can be, cognizant of moving forward. Out-of-town shopping destinations remain more resilient than the city centre, consistently delivering stronger sales growth and recovering closer to 2025 levels. I think I've heard it said anecdotally, I don't know if it's true, but York has more out-of-town facilities per head than any other city in the UK. And these are arguably some of our closest, fiercest competitors that we shouldn't ignore, and we should be trying to kind of, we should be trying to steal back potentially the customer base that we used to have. Food and drink remains the dominant spending category, so that's accounting for more than a third of city centre spend, despite having a softer year-on-year growth. And I suppose if we saw earlier that food and drink was down by around 5% year to date. So if we can aim to recover some of that margin in the upcoming months, then that will actually contribute greatly to the overall city centre sales, because they represent such a big portion of it. So that's something that we can maybe think about how that could be achieved. Health and beauty continues to outperform other sectors. Interestingly, requires more investigation, but fashion and general retail remain under pressure on the whole. So we saw that general retail was currently down 10% for the year to date, trailing quite far behind the national benchmark. And this is putting more pressure on that sector to deliver, I suppose, additional value, keep its prices lower, put emphasis on experience and differentiate to attract new customers, which is a lot, quite frankly, in a time when they're struggling. York residents remain the most important customer group, generating almost 40% of city centre spending. However, their contribution continues to decline, raising concerns about local customer engagement and loyalty. So we all need to think about, bid included, how we incentivize, bring those residents back in to the town, because, they're technically on our doorstep. They're easier to market to than others. We just need to find the conveniences and mechanisms that give them those incentives to come. And then finally, shop vacancy rates in York remain at a historic low and continue to sit well below the latest reported UK high street average. And that's a positive story, but it's also a double-edged sword in terms of it also highlights a shortage for new businesses to come in and find appropriate commercial space, which is a potential challenge moving forward. We've only got a finite capacity. Right, thank you very much for listening to all of that information. It's a lot to take in, and hopefully the slides will help you to kind of refer to it again in the future. We will take a short break now, and I'll look at my colleague Rachel to see if we've got any specific questions that have come in the chat that might be suitable to answer now rather than wait till the end.
So we've only had one question that I can see. If anyone does have any questions, feel free to raise your hand or stick them in the chat. So we've got a question from John asking, what percentage of total spend does debit card expenditure represent?
It's a very good question, John. And unfortunately, it's not one that I'm able to answer. Although I will say that I have tried to research into this area, and websites like the Office for National Statistics will give you, in some cases, a like a split of estimated monthly online spend compared to in-store spending. But I think what we find that when you drill down into more granular sort of views of like different sectors, that changes dramatically. So, it's whether or not we can be confident in about how we present that. So if York is two-thirds food and drink, for example, and we know that 80% of that spend is done in person, 20% is done online or something like that, then that we apportion that appropriately to our centre, because the sector makeup of the city is really kind of key to how you make those calculations. And I think, unfortunately, there isn't the information out there to allow us to do that. There may be a time where we commission some of the consultants out there who have access to this sort of information, have access to visa data, that could do that analysis for us, and we'd be really interested in doing that and seeing what the results were. So unfortunately, we can't give you the split at the moment, but if we do get to a place where we can afford, or we've got enough group buying power to do something like that, then we absolutely will. So watch this space.
Thanks, Chris. And we have a hand up from Kate. After suggesting that we can do that, I'm not quite sure how we let Kate ask a question.
I think I can potentially. Sorry, we are a little bit new to the webinar game, so Kate, I will allow you to mic, so we should be able to hear you. You're very welcome to come on video as well if you wish, but I won't do that without your consent.
That's fine, thank you. Apologies if so. Yes, Kate Gardner, hello. Really interesting. Love a graph. No need to ever apologise about a graph, Chris.
Thank you very much.
You may have covered this at the beginning when you were talking about the data, but the significant point that it's value rather than customer numbers that's driving a significant part of the numbers. Are the numbers net of inflation? You may have covered this at the beginning, because I guess if they're not net of inflation, then is that real growth, and is that translating into profit in the businesses?
It's a very good question to ask, and I suppose one that we haven't really highlighted too much at the beginning. But no, so these are just actual figures. They haven't been altered to take inflation into account. So there is a calculation that needs to be done depending on which sector you're in, because inflation affects different sectors differently. Arguably, it affects the customer in the same way, because depending on what you spend your money on, the consumer is the one that feels the squeeze. But yeah, if there's only for a specific sector, if there's only sales growth of 2% in a quarterly period where we're seeing inflation of 3 or 4%, then you could argue that yes, you're technically losing money there. I think what makes this really difficult to present is that to get to that inflationary figure, the government has to, or the ONS has to do backflips and applies so many complicated manipulations of the data to actually try and make it as small as possible, that it makes it very difficult to apply to real world scenarios. Now, we could go into lots and lots of detail about inflation in food and drink versus the sales growth that we've seen and the national picture, but we're always going to have gaps, so it's very hard to make a definitive, like, this is the amount of money that you're losing alongside inflation. But I think this is generally a topic that isn't very well understood, and is very hard to understand generally, because there is, I suppose,
it's just
there's so many gaps in the information, and it is all kind of pushed through the mainstream press. So you see it on the news, oh, inflation is this amount, but there isn't an awful lot of context on what that means. So I don't know if that's helpful.
No, that is helpful. It's just, I understand the difficulties of demonstrating that. It's just useful to know when we're looking at those numbers. Thank you. And I haven't been able to access the chat. It seems to be blocked, and that may be the case for other people too.
Right. Okay. That's interesting. That's very strange. I don't know if it's the difference. We'll have to do some work on
Yeah, thank you for letting us
this.
know. We are getting questions through the Q&A function. So if you're not able to
Good.
use the chat, if you stick it on the Q&A function instead, and we'll come back to it because I'm seeing a few questions come through now. So thanks so much, Kate. I'm a little bit conscious of time. There are a couple of more questions in there, but I think we'll save them to the end because we've got a few more slides to go through. So Chris, I'll hand back to you. If anyone does have any more questions, please use the Q&A, and Barry and Chris will come back to your questions shortly.
Fabulous. Thank you very much, Rachel. So we will we'll move through this at speed because we don't want to keep you from the rest of the things you have to do today. But as promised, we said that we would do like a deep dive, closer look at customer demographics, which is, will hopefully give you better insights into the types of people that are spending in the city centre and using your businesses, which you can use moving forward. So at a top level, this is data that we get from BT Active again. This is like, yeah, as I said, a very top level look at the makeup in terms of age groups and genders of the people that are visiting the city. And what we can see at a glance here is that during Q2, the largest group represented are those aged between 25 and 34, slight weighting towards males. However, the second largest represented group were those aged 18 to 24, and slight weighting towards females, and then over 65. So, those three being the largest, but on the whole, there's a really broad range of groups, age groups here. So every group pretty much well represented. And this is actually a trend that we see across all of the historical data. So this doesn't really change too much. And it works out as pretty much 50-50 on the male to 50 split, albeit a percentage point either way in any other month or quarter of the year. So nothing really too much to report at that top level. But what's interesting is when we get into what's described as the Experian Mosaic consumer classification. So this is made available through Beauclair, and this is essentially a segmentation of the UK population into 15 individual groups, and the groups are based on factors like their age, their household composition, their type of house they live in, whether they own or rent, their lifestyle, and their affluence, what they spend their money on. So it's designed to help businesses get a better understanding of who their customers are, and where they come from. So it's potentially powerful stuff when used in the right way. The pie chart that you can see on screen shows the share of sales made in York during Q2 by each of those 15 categories, and the names of the different categories are down the left-hand side. I appreciate it's a lot to take in one go. There's a PDF document that explains all of these demographic groups in detail, which we've actually linked to in the figure description there. It's also in the data hub, so we'll leave you to go and look at that at your discretion later on. But we are actually going to look at some of the definitions for what are the top 5 represented groups in this graph. And if we look at the figures, we can actually see that during Q2, over 50% of visitors fell into one of these, sorry, it's 5 categories, not 4, following demographic groups, and they are called domestic success, rental hubs, aspiring homemakers, prestige positions, and country living. So that gives you a little glimpse into what they're about. But yeah, again, broadly, this represents a quite a wide mix of different backgrounds, levels of affluence, and and household incomes, but has a slight weighting actually towards, I suppose, slightly younger groups in the 26 to 35 bracket. So let's have a little look at each of these, and then you can, I suppose, contextualize what this means for you and whether these are actually customers that you see in your business. So domestic success stood out as the largest group. They represent 13% of Q2 spend, and that, is pretty similar. It's a similar makeup that we can see back into the historical data as well. So this is kind of like a static profile, and they're described as thriving families balancing careers and family lifestyles, typically aged between 36 and 45. So slightly older than the sort of the largest share of age group that we saw earlier, but they're homeowners with stable incomes. They often have children living at home. They have strong spending power across sectors like retail, leisure, and hospitality. So they're a key audience for what we might call family-friendly activity, attractions, and engage with things like shopping, dining, and events. So a really nice demographic to have as the biggest one in the city centre. Next, this is a bit of a flip to a very different group. This is rental hubs. So they represent 11.5%, defined as young professionals and graduates living in rented urban accommodation. So likely to be living very close to the city centre or not too far away, typically aged between 26 and 35, educated and focused on their careers in their earlier life, often renting flats rather than purchasing property. I think it mentions there in the residency type, there's 82% of this group are renting flats, which is quite a large number. And they're active users of hospitality and leisure and convenience services, shopping nearby for everyday goods. But they're also a strong audience for using businesses like cafes, bars, restaurants, the experience economy, and some of the evening economy businesses as well, more likely to stay out into the later hours of things like bars and pubs. Next, we have aspiring homemakers. So this is the 10 percentile makeup of the Q2 spend. So these are defined as younger households establishing themselves on the property ladder. So potentially less disposable income to play with, focused on value, and they're conscious about the value of products that they buy. Typically aged between 26 and 35, first-time buyers, first-time home buyers, or recently purchased homeowners. Their spending is focused on things more like home furnishings, lifestyle and family formation goods, homeware, fashion, the rest of it. And then this is the one, I suppose, that we're keen to see, those with the biggest amount of spending power. So affluent families living established upmarket lifestyles, and they're defined as prestige positions. So they're also 10%, typically aged between 56 and 65, often owning large detached homes, either locally or potentially a bit further afield. So these guys have strong purchasing power and are more likely to kind of be purchasing luxury retail items, maybe jewelry, going to see independent businesses, and looking for quality like experiences and premium goods. So essential for some of those higher end product retailers in the city, like jewelers, etc. And then the fifth category, and the final one, is country living, which also stands at 10%. So again, these are affluent homeowners, but they're living a bit further out, so they're based more rurally. Majority of these will be retirees, 66 plus on average, financially secure and owning their own home with no children at home. Children have left, and located in villages and rural areas, likely in North Yorkshire or East Riding potentially, with high levels of discretionary spend. So again, a good demographic to see within these top five. And all of this information is available online as part of the York Data Hub. I was going to show you a bit of the Data Hub where you can access it, but we're probably running out of time on that, so I'll just jump straight to the end. And as I suppose, a summary of those five groups, I think we can therefore make the conclusion that together those groups suggest that the city centre attracts a relatively affluent and economically diverse visitor base, ranging from young renters to first-time homeowners through to established families and affluent retirees. And this is essentially a broad mix that supports a wide range of businesses across retail, hospitality, and leisure. So a really excellent customer base to have. Something we should continue to nurture. Thank you very much. I appreciate we've given you an awful lot of information there, and we are 5 minutes from the hour, so I will stop sharing and we'll jump back out to do a bit of Q&A if there are questions.
Thanks very much. Okay, so coming back to the couple of questions we had earlier. So one from Chris saying, interesting that shop vacancy rate has increased at the same time as April 2026 business rates reevaluations. Do you ask, or are you hearing that this is a reason for business closure?
I suppose there's a bid which talks to businesses on a daily basis. We do hear, I think, just naturally through the work that we do, a lot of anecdotal kind of woes and gripes about how hard it is to run a business in the city centre, particularly in York, because there are, astonishing costs to rents and to rates, and we know that elsewhere in the country, rateable values are considerably lower. So we know it's actually harder to broaden those profit margins in York. So, I've not heard it said directly that the reason for business closures is due to business rates, but I think we can assume that it plays a part in everything that's going on. I think what we would hate to see is, you know, the loss of certain sectors. I think, this is the business rates, as we've said before, are putting particular pressure on hospitality. Hospitality has been rated differently to other sectors, and they've seen, increases of, I think nationally it's around 70%. And that's hotels, bars, restaurants. So I think those are the sort of sectors and retail which are already struggling that we really need to keep an eye on. And if there is a case to be made to central government for reform, which I think there obviously is, because everyone is kind of cognitive that the tax is not fair in its current state, that it should be for those sectors. And yeah, despite whether pubs and live music venues have it, it doesn't go far enough, because if we lose those other businesses in the meantime as a result, then the damage will already be done. So may answer your question, may not, Chris, but again, not a definitive answer. But yeah, I think there's likely indicators that it's had a part to play.
Yeah, I think I would reiterate that it is definitely something that we speak to businesses about. Um, but as Chris said, it's one of several reasons rather than the main reason. A reason that I often hear is about the cost of rent as opposed to business rates. But as you say, it's an interesting correlation to make and something that we can make a specific effort to speak to businesses about. So thank you. And then a question from Barry. Is there any correlation between car parking costs in the city against sales? A comparison with other cities may be interesting. City centre sales seem to have declined in line with an increase in parking charges. Chris, can you speak to that?
Yeah, I can, and I think because this is a topic that we've been very keen to keep our eye on as well, we have actually been looking for that smoking gun, that the parking prices, whether or not you think they're a good idea, sort of analysing the impact that they're having. Um, I think it's fair to say that there has been decline in sales, there has been decline in visits during the period that we've had increased parking. But unfortunately, there isn't sort of a definitive pinch point in the data that identifies the parking as being the main culprit. There's a lot of, I suppose, macro and micro changes occurring, and these all kind of feed into what's going on. So I think what we would really love to see is some data from the council on their car parking revenue, the utilization of the car parks, which at the moment we don't have access to. I think that there's maybe been some information released about traffic on the roads, but that has come more from a congestion point of view, and we would like to see, if we actually have cars in the car park. So if we had that data, we could potentially do like an analysis of the different data sets that we have. But up until now, that hasn't been made available for, I mean, as I understand, there's maybe issues with the reliability of some of that data because of the tech behind it. But if that ever becomes available, which we are kind of continually asking for, to be fair, then we will certainly do that analysis, and yeah, we could potentially talk about it on one of these webinars, or we certainly would publish it in our insights that we put out through the data hub.
And Deborah has also added on a sort of similar vein about parking, pointing to the success of out-of-town shopping, which has free parking, and whether the loss of Clifford's Tower will exacerbate this further. So I think again it's something that we'll continue to monitor, and hopefully we can get access to that data. I think that comparison to out-of-town shopping centres is a valid one, and one that we'll keep looking at, and as Chris says, maybe spotlight in a later webinar. So that does take us to the hour. Does anyone else have any questions they want to ask before we close off? Well, if you do think of any questions, don't feel you need to wait till the next webinar. We're always available on the phone or by email. So please do get in touch with us and go to the BID website where you can look at this in more detail and use that interactive dashboard to get the data that's really relevant to you. So we'd encourage everyone to go and use that. And Chris and I are always available to come for a chat anytime. So please do get in touch with us if you do think of anything. Chris, is there anything final you'd like to add?
Yeah, just to thank everyone as well, and to a final request from me would be we will circulate a feedback survey about today's webinar, and it'd be really helpful if you could just spend a couple of minutes just to give your thoughts on how it goes. We appreciate we do try and fit a lot into these, and it may be better if we did less, but we're happy to tailor it to what you think are the important topics and the kind of structure that you think works best for you, because you're all busy people. So look out for that as part of the email that we'll send out. And just to mention, the next webinar for observing Q3 will be due in around October, November time, depending on the data's made available and how long it takes to crunch the numbers. But we'll hopefully see you all then.
Brilliant. Thanks very much, everyone. Take care.
Cheers. Bye bye.